Hello there. Welcome to the Open here on BNN Bloomberg. Let's get to the big stories we are bringing you from our newsroom. The federal government has signed a memorandum of understanding with Canadian artificial intelligence platform Coveo to boost innovation and integrate Canadian-built artificial intelligence into core government operations. One of the plans here is ensuring Canadian digital sovereignty. Bank of Nova Scotia is planning to revive the metals trading desk it dismantled at the peak of the pandemic. The new desk will trade, lend and hedge raw materials, including precious and base metals. And the bank has hired recruiters to reach out to commodities traders, sales specialists and strategists to staff the unit. This follows record-breaking rallies in gold, copper and silver. Shares in Hut 8 soaring in the pre-market. The Bitcoin miner signed a $7 billion US deal with an outfit called FluidStack for IT capacity at a data center campus in Louisiana. And Google will provide financial backstop covering obligations for the 15-year base lease term. The plan here is to develop and deliver IT capacity for Anthropic in partnership with FluidStack. And there's a look at U.S. futures. They are pointing to a higher open this morning. Let's check in on the TSX and how it fared yesterday under a bit of pressure. Remember, oil dipped to the lowest since 2021. Let's have a look at gold, which has been trading near record highs this week. And you can see pushing further towards that 4,400 mark. Canadian dollar, let's check how it's faring today. Pretty well sideways, down a fraction of 1%. And finally, let's have a look at Bitcoin. No joy there for the crypto bugs. Hut 8 may be up, but the biggest crypto is down a bit. Let's take a look now to 2026 in the markets. We're joined by Lyle Stein, president of Forvest Global Wealth Management. Lyle, thanks very much indeed for joining us. Great to see you as ever. What are the big themes going to be in 2026, do you think?
Well, it's really interesting, Andy. We went this past week and, normally you have to read all these research reports and all the rest. Well, we just used our wonderful AI tools and we asked, what are the biggest risks to the market in 2026? And the elements that came up were at the top of the list, inflation concerns. Second one was, the geopolitical concerns around the world. And then the usual market valuations and things like that. The interesting thing as we look at 2026 is the layout of trying to forecast markets by forecasting what's going on in the world. And as we look at 2026, it's almost going to be as important to forecast what's going on in markets to see what's happening in the world. And that all fits into that K-shaped economy that people talk to. The notion that those who do well are doing really well, but the bulk of people are on the downward slope of that K. So the economic recovery that is milquetoast is being fed by the high earners, high asset owners, and there's still a lot of pain amongst those who aren't participating, those without assets, those without houses, those who are concerned about their jobs. And so all this is in the mix for 2026.
I suppose the richer people tend to own stocks, and they're feeling rich with markets near record highs.
And that's exactly it. I mean, the AI boom has been very important for the U.S. economy. We know that. It's about half of economic growth in 2025. But the wealth that's been created by the AI boom has been particularly good for those who own stocks. And so that is a big driver. If we lose the momentum in the market of those who own AI stocks, because it does look like they're getting a bit tired. NVIDIA is the poster child there. Mm-hmm. That could have an impact on consumer spending, which has an impact on the economy. And it could also have an impact on all the ETFs that own the NVIDIAs and the big hyperscalers.
Wow. Do you think we could? Well, we've talked about this for years, that we could see a flight from index funds and then it would turn into a self-fulfilling thing because the index funds, as they get redemptions, would have to dump those big tech stocks.
That could very well be the case. And now the interesting thing is we're just coming to the end of tax loss selling. Nobody sold those stocks this year because you've got a big tax loss. Now, through 2026, will that in fact hit the market? It's a tough thing to call. We won't be able to make a forecast on whether it'll be ETF redemptions, but we could see a slow drip out of them. And that would be consistent with a general multiple decline in the market, which would be exacerbated by fears of economic slowdown.
What do portfolio managers tend to do at this time of year, Lyle? We hear about window dressing. What are the main goals here?
Well, the number one is just to finish the year on a good note is the most important thing. Window dressing, the notion that I wanted my portfolio for December 31st to look like more of the index, more of the things that won. I think that's been somewhat lost with, as you said, the rise of ETF investing. But active managers, don't want to be too far offside if they're managing funds that are on a relative performance basis. At our shop, we're more absolute performance than relative performance. And so we don't mind if we have what we would call in the business bets on certain areas of the market and then bets against other areas of the market. So again, that window dressing applies primarily to index huggers, not active managers looking with a total return bias.
I guess people think there's a safety in numbers, a herd instinct among portfolio managers, and they tend to hold the big funds anyway, very much the same stocks.
Well, and that's a big risk here because you got to be the smarter guy is the one who's going to be ahead of all the rest. And so once the first button pusher goes, everybody else will pile on. That's where it gets really tough. That's why as we look at the world for the next 1 year, 3 years, we have a consensus view. We know what that is, but you have to ask, where is the consensus going to be right or wrong? So it's almost better to look at the analysts that have the lowest estimate on a particular stock and the highest estimate than it is to look at the consensus number and see how that's changing.
What about trade and tariffs? I mean, that's a very broad topic, but we are going to get the renegotiation of or beginning of a reworking of the North American trade agreement next year. Of course, we'll get lots of pronouncements and heat and noise from the White House, but is that a thing you're paying much attention to? Obviously important for the Canadian economy.
I think it's particularly important for Canada relative to the rest of the world. We're still living with, very high tariffs imposed upon us. And if we lose the NAFTA agreement, we're at risk of seeing even further tariff increases, just given the appetite for Canadian-American relations right now, it isn't necessarily that great. But more importantly, we've got the big decision we think is coming maybe this year, maybe early next year on what happens with those tariffs at the Supreme Court. We've heard also that companies are holding off increasing prices till they get some clarity, perhaps from the Supreme Court, before they might raise prices in the first half of the next year. And then there's all this discussion about, well, if the tariffs roll off, that'll be more of a second half of next year. So the tariff uncertainty is pretty high. I think you have to, again, look at it in the context of the securities you're owning as opposed to the market ETF that you own.
I mean, in fairness to Prime Minister Mark Carney, the tariffs, there's big levies, as you note, on steel, aluminum and lumber, but we've dodged the worst of it because if they're covered by the North American Free Trade Agreement, Trump isn't tariffing them right now.
Well, that's right. And that's the risk that we face if, in fact, the NAFTA, or sorry, the USMCA is torn up. If that's torn up, then we could face some additional pain. But again, I think we'll get clarity out of the Supreme Court. And also the Trump administration is talking about what they're going to do if, in fact, they lose at the Supreme Court.
Right. Yeah. The rules, of course, the system's against Mr. Trump. Everyone's been very unfair to him. Lyle, we'd better leave it there. Lyle Stein, president of Forvest Global Wealth Management. Thank you very much, Lyle. Up next, we are going to examine the challenges facing the Canadian lumber industry. And yes, tariffs are a big part of the problem. been a tough year for Canadian lumber with mill shutdowns and curtailments. So what options are there to alleviate the pressure on the industry? Total effective tax burden, for example, on the average Canadian mill with these levies has now climbed above 45%, driven by US import duties. We were joined by Mark Parsons, chief economist at ATB Economics, and we started off by discussing the steady decline in our lumber exports to the US.
This is an industry that's been hit on a number of fronts. This is just the latest, as you mentioned, 45% effective tariff rate. That includes 35% on those duties that went up from 15% since Trump took office. But even before Trump 2.0, this is an industry that has long faced tariffs, or duties as they call them in the industry. And then the industry, it's gone through the U.S. housing collapse, wildfires, a number of mountain pine beetle. So there's just been a number of challenges that have inflicted this industry. And this is just the latest.
It is interesting. You mentioned the mountain pine beetle destroying just swathes of the Canadian forest. And BC in particular is a high-cost jurisdiction. It's hard to compete.
Yeah, I mean, if you really look at the last couple decades, it has been a BC decline in the industry. Other provinces have held up relatively well, but they're also down. So you've seen a number of things happen. The mountain pine beetle disproportionately hit BC. Then you add the duties on top of that, and then some more domestic policy issues. It's just created a very difficult environment. And the latest is you have West Fraser coming out announcing that they're closing the 100 Mile House mill, which is 150 to 200 jobs. But it's not just BC. Here in Alberta and high level, West Fraser's announced they're going to curtailing indefinitely their operations, which is about 190 jobs. So this is the industry in turmoil right now. The federal government has come out with some measures, and we're going to have to wait and see how effective they are.
We actually talked to Tim Hodgson, the Minister of Natural Resources, yesterday. He's launching this task force. I mean, there's only so much he can do. But it was interesting. He seems to be interested in exploring with the industry a fundamental change in the way it does business, in particular focusing on the Canadian market with value-added products.
Yeah, I mean, that makes a lot of sense. This has been the response, right, by Canada to the Trump tariffs. I think the challenge with that is this is a very export-oriented industry. The vast majority of its exports go to the U.S. That's a longer-term play. If we can get more domestic supply added to the market, that's fantastic. More value added, that's also something we can do. We also need to look overseas markets. But I consider that more of a long-term solution, Andy. I think in the near term, we need to deal with the U.S. That's the only thing that can really alleviate this. Hopefully we'll get a bounce back in the market too. U.S. housing starts likely will pick up next year. This is an industry that very much depends on the state of the U.S. housing industry. So I'm looking for maybe the U.S. will kind of see Canadian lumber as, well, putting tariffs on this stuff is just raising our costs to builders at a time where affordability is a major concern in the U.S. with 3% inflation. Maybe this isn't the best idea, especially when Canadian lumber is of high quality.
It always interests me, though, that the U.S. lumber interests seem to have the ear of politicians in Washington, and the home builders can't seem to get that message across.
Yeah, there's just this ongoing battle between the two groups. U.S. lumber producers are saying Canada is flooding the market. They're subsidizing their product. There's no evidence of that, as far as I can tell. Then it just gets held up in dispute. And right now, if you listen to home builders, they're saying, look, this is raising our costs. You got to stop this. And it is. I mean, the BDL, the Business Data Lab, done by the Canadian Chamber of Commerce, talks about the combination of lumber tariffs and other tariffs that the U.S. is imposing is adding about $14,000 to the price of a home in the U.S. So I think really with the U.S. still struggling with inflation, they're going to want to rethink whether this makes a lot of sense for them right now. And the truth is 20 to 25% of the lumber that's needed in the US is supplied by Canada, and you can't replace that overnight. And the industry does not have the capacity to ramp up to fill that gap.
How much does it add roughly to the cost of a US house?
Well, look, these are just estimates done by the Canadian Chamber of Commerce. But if they look at the additional tariffs that are being added, so steel and aluminum and lumber and all those things, as building to, all these tariffs are adding about $14,000 to the cost of a home.
Mark Parsons, Chief Economist at HEB Economics. Up next, we're going to tell you about a $167 billion energy project underway in China. Apparently, they are building the world's biggest dam. This thing is so big that it will affect the rotation of our planet and make our days a fraction of a second longer. In one of the most earthquake-prone regions on Earth, where the Tibetan Plateau meets the Himalayas, China is building a colossal hydropower system, pushing engineering and geopolitics to the limit. For more, let's check out this Bloomberg doc.
For decades, the Three Gorges Dam has stood as a symbol of China's engineering might. A project so vast that NASA said it measurably altered the Earth's rotation, making days 0.06 microseconds longer. The Three Gorges Dam generates more electricity than any other power plant on Earth, enough to light up more than 70 million homes a year.
But on the edge of the Himalayas, China is planning something even more ambitious, on a river you may never have heard of.
This is the project of a century.
The most impressive power generation system ever envisioned.
It's the hydropower equivalent of a mission to Mars.
But to build it, China must tunnel through mountains that are still rising in one of the most earthquake-prone places on the planet. And that's not all. What happens here could affect hundreds of millions of lives downstream in neighboring India and Bangladesh, risking new tensions over water. The engineering is unprecedented. So are the stakes.
There is like this stark beauty. It was called the roof of the world because it's the highest part of the world.
From the glacial melt here, the Yarlung Sangpo River flows over 1,000 kilometers east along the edge of the Tibetan Plateau, before performing what many consider a geological miracle at a location known as the Great Bend, right where the plateau meets the Himalayas.
It does this mad turn, so it stops flowing east and does a big hook and starts coming back and flowing west.
About a 180-degree bend where the river drops about 2,000 meters in elevation in just a 200-kilometer period. Then the river leaves China, goes into India, and there it's known as the Brahmaputra. And then it empties out in the Bay of Bengal.
亚夏水电工程体量大、周期长、影响远。
But it's back at the Great Bend, where construction of the Yasha, or Lower Yarlung hydropower project, officially began in July 2025. It's a place so remote, a road only reached it in 2013.
The gorge of the Great Bend is the biggest canyon in the world. It's literally 3 times deeper and a little bit longer than the Grand Canyon in Arizona.
It's this natural drop, the world's steepest and deepest, that also gives the plateau its greatest hydropower potential. Those following the project say China's ambition is not just to tap this power, but to utterly dominate it.
The energy generation from this project will break like records in like many different dimensions. It will be by far the world's largest individual source of energy, 60 gigawatts of installed capacity.
The Chinese government has said that this will generate about 300 billion kilowatt hours a year. That's more than the UK uses an entire year. It's also about 3 times more than the Three Gorges generates.
With little known officially about the project, including the construction timeline, analysts outside China have had to rely on social media, state television, and satellite images to piece together its design.
Not so long ago, an article was published in Nature, one of the premier peer-reviewed academic journals, that roughly describes the project as a diversion project.
Unlike a traditional walled dam, observers believe this one would be made up of a series of hydropower stations along the river. Theories vary, but some outside experts suggest there would be one upstream dam with a large reservoir to regulate the water flow. This would be followed by a second smaller dam at the top of the gorge, where water would be diverted from the Great Bend through the mountains via a number of underground tunnels and turbines, before potentially entering another smaller re-regulation dam at the bottom of the gorge. This could stabilize the flow before the river continues downstream into India.
This will be quite an engineering feat. After all, you're literally reconstructing a whole river underground. The volume of water that will be diverted here will be similar to the discharge of a medium-sized river, such as like the Rhine in Europe.
It's a concept already tested at the Jinping dams, where engineers diverted the river through the mountains.
But what is really novel about this project is just like its sheer scale, where like many engineers would have probably not believed that building such a project in such a remote location would be even possible.
Okay, they do things on a big scale. Let's check out US futures as we move towards those opening bells. Where's the S&P? 6815. So it's still down from last Thursday's record high close of just over 6,900. But you can see it looks like we are going to get stocks opening in the green this morning. And let's have a quick look at gold. Gold's not far off record highs. The spot price of gold right now on my screen showing 4327. 4327. You can see those February futures are higher. The record price for spot gold was October 20th at 4356. So we're only about $30 away from that. Those opening bells coming up next. There you have it, the opening bell action on Wall Street and Bay Street. At the NASDAQ, the bell is being run by Medline. Over at the NYSE, it's Anderson Group celebrating its IPO. It's time for the first 50. And let's check in on those markets to see, yep, the optimism is holding. There's the TSX moving up about 0.5% today. Let me just check if we are still down from our record high. I believe we are. Yep, sure enough. The TSX record high was 31,660 on Thursday of last week, so not quite back there. You can see the S&P now narrowly down. Couple of stocks that are on our radar. Dream Industrial has struck a deal with Canada Pension Plan Investment Board. They're going to form a joint venture to buy as much as $3 billion worth of industrial real estate. CPPIB will put in $1 billion in equity capital, and the plan here is for Dream Industrial to allocate $100 million. And let's have a look at poor old Enghouse Systems. I say poor old because the stock has suffered lately. RBC sticking with a hold on the stock, saying that when you exclude acquisitions, their business has been shrinking. Apparently, the Q4 quarter was mixed. Adjusted EBITDA top consensus, but revenue missed. And RBC, as I say, sticking with the hold and cutting the price target to $22 from $24. And let's have a look at Tesla shares, because they hit a record high yesterday. Not sure if we have Tesla right now. The stock did slip in pre-market trading, but they hit a record high, as I say, yesterday, despite fears over competition globally from the likes of China's BYD. Now, just looking at the Magnificent Seven stocks this year, Alphabet's been the star, unbelievable, up 62%. Nvidia is up only about 32% only. Tesla, not doing too badly. It's up about 21%. Amazon is the dog. It's up only around 1.5%. And Apple has been a laggard, relatively speaking, up less than 10%. Up next, we are going to hear from Alexander McDonald of Focus Wealth Management. He'll give us an idea of what he's looking out for in 2026. Let's take a look at the broad market, and we are joined by Alexander McDonald, Portfolio Manager in Focus Wealth Management. Thank you very much indeed for joining us, Alexander. Really appreciate it. What are the big themes you're looking out for in 2026?
You know, just before the break, Andy, you were saying Amazon was a bit of a dog. To find some dogs, some real dogs from 2025, we can look no farther than the pet industry, actually. So more recently, we've had some well-publicized weakness, in industries associated with tariffs. And then with youth unemployment, of course, it's been another theme where we've seen some weakness in spending there. But independently, two separate companies operating in the pet industry have recently flagged some weakness within that industry. And that's a bit of a departure from what we've seen historically there. If we go back to 2019 to 2024, we've actually seen households in Canada with dogs increase ownership by about 3.3% a year. And even if we go to the premiumization or humanization of pets within the household, premium dog food sales have increased about 12% year over year over that same period of time. So what we've seen recently in this industry with a slowdown in sales is a bit of a departure from what we've seen over the medium and long term. And we think if that reverts to the mean, some of the names I'm going to talk about here could do well over the coming years.
Is Pet Value one of the names that you're talking about here, Alexander, PET, in Toronto?
It is. Pet Value is the first one, so I'm sure a lot of viewers are familiar with it. It's a retailer of pet supplies coast to coast in Canada. It's got about 850 stores. Leading market share in Canada as well, about 18% of the spend on pets in Canada goes to Pet Value. More recently, though, the stock has been down. It's down about a quarter since September, and that's on weaker same-store sales than what investors were expecting. Barely above zero, barely cracking any growth at all, and that compares to the previous 5 years where it averaged about 10% same-store sales. Management has blamed this on, as I alluded to earlier, weaker consumer spending, specifically on the discretionary side of things, so those pet toys that you don't have to go out and buy for your dog, but you maybe choose to from time to time. Those sales have not been keeping up. Longer term, though, we do like the opportunity. Pet Value has a very good customer loyalty program that's untapped, that I think they can really dive into a bit more and start to upsell customers with more and more goods. And they've also just completed a $100 million investment into building 3 new distribution centers in Canada, which we think solidifies their moat and is going to make it harder for competitors to compete with them. And lastly, with valuation at 16 times earnings, we think it's pretty attractive for investors to get in here, which we recently did at Focus, buying within the last month or so.
Any other stocks that have lagged this year that you see value in, Alexander?
Yeah, specifically with the same industry, Zoetis is another one it's down about 25% year to date. So,
sorry, that's the animal health player.
Correct, yeah. For people who aren't familiar with it, pharmaceuticals for animals is where it specializes. It's about 2/3 companion animals, so pets and so on, and 1/3 livestock. It's suffered as well for a couple of reasons. One of them, as Pet Value mentioned, consumer spending, discretionary spending isn't what they had expected. So as it applies to Zoetis, people aren't taking those discretionary trips to the vet. And if they don't take their pet to the vet, they're not getting prescribed pharmaceuticals. But secondarily, and this is more specific to Zoetis, what was supposed to be their next blockbuster drug, Librela, it's used for osteoarthritis pain in canines. It didn't pan out to be that next big blockbuster that they were hoping for it to be. There's some controversy on social media about whether there are some side effects that aren't welcome in these animals. Whether or not Librela does bounce back and become a next big hit, we're not specifically worried about that because we think longer term Zoetis has a great drug pipeline. They spend about 2 times as much as their next closest competitor on R&D, so we think that pipeline can continue to grow. So longer term, we think it should do well, and it's only trading about 18 times earnings for it has pretty dominant market share. It's normally the number 1 or number 2 player in each of its key segments.
I'm looking at a headline here on Bloomberg that our population in Canada slipped only by 1/5 of 1% in the third quarter, first since COVID. I wonder, is that bad news for some retailers, fewer new households being set up in the country?
It is, and that is contributing to some of the weakness we've seen amongst retailers of all shapes and sizes. I mean, not just in the pet industry, but in the U.S. too. Some of the lower income households aren't spending as much as retailers would like. But, we're not going to invest, at least in focus, one quarter at a time. Over the long term, population growth should, come out somewhere between that 1% to 2%, GDP growth sort of around 2%. And for those well-performing companies like the Pet Values and the Zoetises, we think with good operations and an attractive offering to their customers can obviously grow a lot more than that over the long term.
What about the Canadian banks? Obviously a mainstay. They have been hitting record highs this year. Are you overweight or underweight?
So we own 2 banks, Royal and Scotia. Royal obviously has been the top performer of the group for quite a long time. As a result, it gets a premium multiple, but most people would argue that that's deserved. We're happy owning it here. It continues to execute very, very well. We like it specifically its operations in wealth. They're a little oversized in that business compared to some of the peers. Scotia, when we bought it, I think it was back in June or so. It was unloved. It was one of the laggards of the group. They're a couple years into a bit of a refresh of the strategy, a bit of a turnaround. And it was trading at a pretty discounted multiple compared to the peer group. We thought that discount was not warranted, which is why we decided to go in and buy the shares. And it's worked out pretty well, thankfully, since then. But we continue to hold it, continue to like it, and we do think it has quite a good runway going forward. It's really focusing on its operations in Mexico, U.S. and Canada, as opposed to some of the Latin American operations it's known for previously.
I think we better jump. Alexander, thank you very much. If we don't talk to you before year end, have a great holiday and a wonderful 2026.
Thanks, and Merry Christmas to you too, Andy.
Thank you very much indeed. Alexander McDonald of Focus Wealth Management. Yesterday on Market Call, we were joined by Gordon Reid, President and CEO of Goodread Investment Counsel, covering U.S. equities. His top picks were Amazon.com, so he sees beauty there after the stock underperformed this year, Citigroup and Wesco. And today on the show, it's Chris Blumus, Portfolio Manager at Raymond James Investment Counsel. The topic, North American large caps. Up next, we're going to tell you about a plan by Phillips 66 and Kinder Morgan to deliver gasoline to California via what could become the world's biggest fuel pipeline. U.S. federal and state officials are lining up with the oil industry to support a plan by Phillips 66 and Kinder Morgan to deliver gasoline to California via what could become the world's biggest fuel pipeline. The Phillips 66 CEO, Mark Lashier, sat down with our Bloomberg partners and discussed his view on pipeline demand.
I think that for refining, really, we want to see consistent crude prices. But in the short term, as crude price drops off, we do see margins expand in refining. And currently, refining capacity is somewhat constrained globally. And so generally, we're able to withstand that and maintain or perhaps even expand margins. Now, margins had been contracting seasonally, and so you have a conflation of all those things coming together. But the 2 big things out there, you had reports that unemployment is up slightly more than expected, which was a downward pressure on crude. And then you also have the potential of peace breaking out between Ukraine and Russia, which I think would be a fabulous development, but near term, that's going to put pressure on crude prices.
Well, I want to talk about that a little bit. You used a great term earlier that when it comes to the geopolitical premium that's in the oil market, it's sell the rumor, buy the fact sort of situation. And as we look into 2026 with, of course, geopolitics top of mind, what does that mean for the broader refining outlook and specifically for diesel as well?
Yeah, we continue to see tightness in the global refining capacity. Even some of the newer assets that are online in Nigeria, Mexico, they're running at, say, 40, 45% or less. You see refineries being rationalized. We ceased operations at our LA refineries. Some of our competitors are talking about rationalization as well. And so globally, refining capacity is tight. And so that's a structural thing that no matter what the crude price is, we should be able to see constructive margins going forward in refining.
Well, can you talk a little bit about the capacity for actual shipping and transportation of that energy? I think we are supposed to get some sort of a green light potentially out of the U.S. government with regards to the Western Gateway pipeline. Are you anticipating, A, that will be approved, and 2, are you still committed to building out?
We're in the middle of open season. That's a process where we see what shippers are interested in moving refined products on that. And that Western Gateway pipeline will move gasoline, diesel, jet fuel from the mid-continent, very competitive refineries, out to Phoenix, California, and Las Vegas. And it'll provide much needed relief for California as refineries are coming offline there. And we think that there's strong support at the federal government. There's strong support in California as well as adjacent states to have that additional supply coming in. And we've got a strong position in the mid-continent. We're certainly going to participate as a shipper on that pipeline. And we've had good response. But that open season doesn't close until the 19th. And then we'll see what things look like from there and decide how big the pipeline needs to be and if the economics are there for us to proceed. But we're pretty confident at this point.
Well, speaking of California, let's talk about your Rodeo renewables plan. The rollout of renewable diesel and sustainable aviation fuel, it's been a little bit rocky. And I wonder, at what point will Phillips 66 make the decision to shut the plant or perhaps convert it back to fossil fuels?
It would be a challenge to convert it back to fossil fuels, but we're committed to doing everything within our control to make that facility viable. The facility operates even better than planned, better than expected, but the real drivers are around the regulatory environment, the subsidies in effect that support it. It is one of the largest renewable diesel facilities on the planet. It generates about 15% of the renewable RINs in the market, so it's a big participant in generating RINs. It produces a large volume, about 600 million gallons a year of diesel fuel. It also is a big consumer of soybean oil, so it's good for the American farmers for this asset to be running. We're doing everything in our control to make sure that it's not just viable, that it's profitable over the long term. We've taken about $100 million of costs out of the facility. We've invested in logistics infrastructure to move more domestic feedstocks into the facility, and we're finding markets overseas that are very attractive for the renewable diesel as well as sustainable aviation fuel that we produce in the facility.
So you've had constructive conversations with the governor of California, Gavin Newsom, on this issue?
Yes.
And you're confident that you'll sort of find a way to meet in the middle on this?
They understand the challenges around Rodeo. They understand the things that they can do with their LCFS program, and we believe that they'll be constructive. And we've also had discussions at the federal level around RINs, the application to RIN values for imported feedstocks. All of these things are impactful to the economics of the Rodeo renewables complex.
I am curious about the discussions that you've been having with investors, particularly activist investors, and the campaign that Elliott management has led. Where do you stand right now in that relationship, and do you anticipate that they are coming back to the table with a little bit?
We have frequent conversations with representatives from Elliott Management. Our investor relations interact with their analysts on, I think, a weekly basis. So we're quite close conversations, just like we are with all of our shareholders, and those discussions have been constructive. We're both very aligned on creating value out of our assets and returning value to our shareholders.
Just on that point, you have 2 new board members from Elliott. Is there anything specific that has been pushed for in recent board meetings?
Yeah, we have a process when new board members join our board that we onboard them. They have access to all the information that they didn't have access to publicly. They have access to our people down in the organization to see how things really are running, how we're creating value. And this time was no different. We had 3 new board members. 2 of them were nominated by Elliott, and it's been a very positive process. They've been through several board meetings. One of these board meetings involved a deep dive around our strategy, and they had their opportunity to engage, and they engaged fully around the discussions around our go-forward strategy. So our board is aligned, and they're all pulling for the best interests of Phillips 66's shareholders.
After the break, we're going to check out oil prices. They are up a bit today. However, yesterday they hit their lowest in almost half a decade. We'll have more on crude after the break. We saw some strength in oil prices today, but yesterday crude dropped to its lowest in almost half a decade. And this comes after the rally today comes after US President Donald Trump ordered a blockade of Venezuelan tankers. Let's get more from BNN Bloomberg's Lindsay Biscaya. Lindsay.
Yeah, and Brent prices today, Andy, up more than 2%. That's above $60 a barrel. This after Trump ordered that complete blockade of tankers going to and from Venezuela. So this is the latest in a ramp up of what we've seen with the U.S. targeting Venezuela, mostly their tankers and their ships. Under international law, a complete blockade is actually an act of war. But Donald Trump is saying he only wants to block sanctioned oil. He also says he's designating Venezuela's government as a terrorist organization. Legally, that would have to be taken. That step would have to be taken by the State Department, though. So obviously, that's just words coming from Donald Trump at this point. But this is all circulating around oil. And as we know, Venezuela has vast oil fields. They produce about 1 million barrels a day. Their production currently represents, though, less than 1% of global supplies. So any impact on the market will most likely be marginal. That's coming from many experts, from many economists on Bloomberg today, because we're dealing with an oversupply right now. But Venezuela does have a lot of oil. They ship about 80% of that to China. And in the last couple of years, they export about anywhere between 16 to 20% to the U.S. So a marginal impact at this point, but it's interesting to see the price actually climbing today after what we've been seeing for months now.
I'm just looking at Canadian Select, the heavy oil. It actually in June it got up to around $60, but it's barely above $40 US yes. right now.
Exactly, it has dropped quite a bit. This is probably not a good impact when it comes to the Canadian oil market. We were speaking with Dan Rahinton, IA Global Asset Management today, and he said Canadian oil just isn't as profitable as it maybe could be had we started really extracting a lot of it. Before, like a couple of years ago. We're a little bit late on the uptake. He says Venezuela has very heavy, expensive oil, much like Canada. It takes a lot of engineering. It takes a lot of money to be able to extract that from the ground. And in recent years, the U.S. has started importing more Venezuelan oil to replace Canadian heavy crude oil. And so Dan Rahinton talking today, really interesting about how Canada probably needs to diversify and maybe move away from the oil market as we see this supply glut coming in the new year. Here's more on what he had to say.
When you think about oil prices and where the direction of travel is going, we are moving into a post-oil scarcity world in the next 10 years. And I don't think I would have said that many years ago. And the reason for that is the amount of solar that's being put into the ground, all the other natural gas peakers and baseload that's being spun up, on top of the fact that nuclear is having its moment in the sun once again. Mm-hmm. All of these things is abstracting away the energy use case. So 100 million barrels of oil a day, will it be more 10 years in the future? Of course it will. But it will not be the primary bottleneck energy source in the way that it's been historically, and that's generally bad for prices. And then the whole question is, we talked a lot about Venezuela, we talked a lot about Russia. What does it mean for Canada? Canada's wealth and prosperity is anchored to the energy markets. And the pipelines aren't full on the way out of Alberta right now. That is an interesting thing to monitor, and we're probably going to have to find other sources of competitiveness in our national economy, because the same reason that that Gulf states have moved on, we've been slow to extract it, and I think that moment in the sun for oil has passed.
So interesting to hear, as you mentioned, Canadian oil, Western Canadian Select down to about $41 a barrel today. Back in June, it was about $65 a barrel, so it's gone down quite a bit. And it's interesting also to see, with all of these different moving parts, the price of gold is going up today too, with what's happening in Venezuela, and that's mostly because many investors running to a quote-unquote safe haven. When it comes to looking for something other than, investing in oil prices right now as we see this fluctuating. But It's interesting. We're going to have to keep an eye on it. There's also the whole Russia component. The U.S. now preparing new measures if Russia rejects the latest peace deal that's on the table. And Donald Trump has talked about maybe targeting Russian so-called shadow fleets of tankers of oil as well. So we're going to have to watch that too.
Lindsay, thanks very much indeed. Lindsay Biscaya. OK, we have lots more. Let's check in very quickly on the equity market and see how the TSX is doing and major sectors. And there is the TSX. Rallying, not quite back up to its record high of last Thursday. One big mover, we mentioned this earlier, is Hut 8 in Toronto. HUT is the symbol. They have teamed up in a deal valued at $7 billion US with a company called FluidStack. This is a Bitcoin mining operator and also a data center operator. And the deal here is to cover 245 megawatts of IT capacity at its campus in Louisiana, and Google is backstopping the deal. Investors excited to hear about that one. Coming up, we are going to take a look back at 2025, and we're going to focus on some extra volatile stocks. We'll be right back. Okay, let's get to the headlines and welcome back to our show. Federal government and Ontario are expected to sign a deal tomorrow to reduce the regulatory burden on large projects. That's according to a report from the Canadian press. The deal is set to include the road to the Ring of Fire in northern Ontario. It's said to be full of minerals, but Indigenous concerns have been one roadblock there. Ottawa has agreed to eliminate any duplicate work on its impact assessments on large projects, and apparently these changes would also speed up projects across Ontario. Shares in Hut 8 Corporation soaring. The company is going to develop and deliver at least 245 megawatts of power and up to 2,295 megawatts of AI data center infrastructure for Anthropic, the AI player. Investors excited there. Bank of Nova Scotia is planning to revive the metals trading desk it dismantled at the peak of the pandemic. The new desk will trade, lend, and hedge raw materials, including precious and base metals. The bank has hired recruiters to reach out to commodity traders, sales specialists, and strategists to staff the unit. The move follows record-breaking rallies in gold, copper, and silver that have renewed interest in metals. There is the TSX. You can see it is higher in early trading. Let's have a look at the U.S. markets, because the S&P was positive in the pre-market, but now slipping, or let's just call it flat. Big traders in the United States. Tesla down just under $2 after hitting a record high yesterday. Nvidia is down about 2.5%, as is Broadcom. Another bad day for Broadcom. And even Alphabet, which has been a Mag 7 darling, is about 2%. Oracle shedding another 4%. Quick look at oil. Lindsay Biscaya was telling us about that. That oil rallying a little bit today, but yesterday it hit its lowest since 2021. Jumping ahead to gold, let's get an update here on gold. And you can see those February futures hitting what appears to be a new high, but I like to monitor the spot price for gold. And right now, we are looking at a spot price. It is higher for 4,338, and the record back on October 20th was 4,356. And finally, let's check out the Canadian dollar, which has staged quite a rally lately. It is losing a bit of altitude today against the greenback. between tariffs and fears of an AI bubble, 2025 has been a volatile year, but pretty good for stock market investors. Let's get more on the price swings we've seen for certain stocks. We're joined by Grant White, portfolio manager and investment advisor at Endeavour Wealth Management. Grant, great to see you. Just start off 2026. What will your strategy be, broadly speaking?
Yeah, well, good to see you as well, Andy. I think that 2026 is going to be an interesting start to the year, to say the least. I mean, 2025 has been a very interesting year, as you point out, lots of volatility, and I think that's going to continue into 2026. Where we're probably going to see, some profit taking continue on. I think everybody, we're seeing a little bit of that, and we're obviously right now, especially in the Mag 7. But I think everybody wants to see a good year, a good number to finish out 2025. Now to start out 2026, I wouldn't be surprised at all to see a dip in the markets. And so I think investors need to be very, focused on fundamentals, focused on high quality as you enter into 2026. Diversification, I think, is going to be important if you want to see consistency in your portfolio. And I'm not saying that 2026 can't be a good year. I just think we're going to see a little bit of rockiness up front, and then we'll see where things go from there. Obviously, a lot can happen.
What do you mean by high quality, Grant? I hear portfolio managers say that, but what are you referring to?
Yeah, that's obviously an easy one to toss out. I mean, what it really means is I'm focusing on balance sheets right now, especially focusing on cash flow, just to make sure that we are into, we're holding companies that can sustain storms, can sustain the weather. And I'm not so worried about share price, although I am concerned about valuations. I'm not so concerned about, the type of company. I'm more focused in on the balance sheets and the cash flow at this point, and making sure they're strong. I'm avoiding speculative bets, which we've seen a lot of that this year. And I think there's been a lot of speculation about where things can go, especially in AI going forward. And so I'm focusing quite a bit more on the fundamentals of the company, if you will, going forward into 2026.
You have some stocks that you've been watching that have been volatile this year. Let's start off with Cameco. I believe you reckon this is a buy right now, but we did see some swings. Let's have a look at CCO.
Yeah, so this company has gone through a lot this year. I mean, I think we've seen downside of 30 to 40% earlier in the year, and a lot of upside, following through as things continued on, as we, went through Liberation Day, as the AI trade continued to pick up steam. Companies like Cameco have also participated in that momentum, and I still really like Cameco because, the story's still there. I think from a valuation perspective, it's fairly priced. I don't know that it's super cheap right now. I don't think so, but I think from a valuation perspective, I think it's fairly priced. And I think there's a lot of tailwinds that can help to lift Cameco going forward. It's certainly on trend. We believe that energy production is going to continue to have to increase in order to meet the needs. That was already the case. AI just went through the roof on that, obviously. And so Cameco, I think, is going to be an important company going forward. And other companies that are around, energy production, I think are going to be really important. So Cameco is very well positioned going forward.
And a name that you're more cautious on, I think you call it a conditional buy or a hold, is Air Canada. What's your broad take on that one?
I always struggle with airlines, Andy. I mean, I think that, Air Canada is a pretty well-run company. I think, they're managed quite well. They've weathered some big storms as well this year. I mean, they've had, labor outages. They've had, strikes, et cetera, going on this year. And so all of that, there was a lot of headwinds. On top of that, I mean, there's been obviously a challenging environment. Travel to the U.S. is down, and so on and so forth. So for all those reasons, I think Air Canada has actually weathered the storms pretty well. I think they're down about 16% or so in the year, 25% over the 1 year mark, as you're pointing out on the charts there. So it's not that it hasn't been without its bumps. We saw big declines and then a nice rebound, and then kind of settling out at this point. So I struggle with this one a little bit just because I don't like the environment per se right now, but I think that they are a really well-run company. And so from a pricing perspective, I think they're all right. You just have to like the story going forward. And I'm not a huge fan of airlines as an investment overall.
Tesla is not a stock that you'd be putting new money into right now.
No, I mean, Tesla, it's difficult because, we talk about speculation. I mean, the reason you would buy Tesla today is because you're speculating and you believe that they can accomplish, the robo-taxis, autonomy in scale, not just in one center or a few centers. They have to do this on mass scale. You believe the story about Optimus and the robots and what they're going to be able to build and be able to produce 1 million robots here. If you believe those stories, then Tesla, I think, is underpriced today. It's probably worth 3, 4, 5 times what they're trading at today. Now, that being said, there's a lot of things that can get in the way of that, and there's a lot of competition that's already out there. I was chatting with a friend of mine who lives in Europe a couple weeks ago. I was chatting with them, and nobody's buying Teslas in Europe. They're buying BYD. They're buying like Chinese-made cars, and so I think there's a lot of challenges that Tesla is facing. I would say we're holding on to it. I'm a personal shareholder. I have been for a long time. I'm holding on to it. We're not adding to it, but it's an interesting company. It always is, and I think there's a lot to like about it. I just don't like the valuation. If you ever get a price opportunity on Tesla, though, I think it would be good. It's a good one to buy.
We've seen some price swings in Micron Technology. At one point, it was down 75% amid fears of a chip glut.
What a tale of a year of two tales, I guess. It's obviously faced mega struggles in the beginning of part of the year, and then has absolutely been lit on fire since about April, early on in April, and to date right now. So Micron is a company that we really like still. I mean, if you like the AI story, which I don't know how you don't like it going forward, I think there's going to be some bumps along the way, which we're kind of encountering now. But Micron produces memory chips, which is a really key component in the entire AI story. And frankly, in all of this new technology that we're building, I mean, they were important before, and I think they're that much more important going forward. This is a real pickaxe and shovel type of investment in the AI trade. And so if you think that AI is going to continue to expand, Micron should do very well. From a valuation perspective, I think they're pretty fairly priced as well right now. It's not that they're cheap, but I think there's a lot of runway ahead of them. And so I think you can like this company going forward. And certainly, again, it's been a year of two tales with it. I mean, so it's been an incredible lift since about early April on there. And I expect that will continue in for years to come.
We better leave it there. Grant, thank you very much indeed.
Thanks, Andy. Always a pleasure.
Grant White, Portfolio Manager and Investment Advisor at Endeavour Wealth Management. Coming up, Ford plans to take a charge of almost $20 billion on electric vehicles. It's killing off several EV models. We're going to get a Canadian perspective after this. Ford is taking a charge of $19.5 billion US on its electric vehicle business, and it's killing off several EV models. US President Donald Trump's policy is not favorable to zero-emission vehicles. Let's get a Canadian perspective here. We're joined by Flavio Volpe, President of the Automotive Parts Manufacturers Association. Flavio, it is a bit of a depressing list, isn't it? GM was making those electric vans in Ingersoll, Ontario. They cut back production. Honda postponing a $15 billion EV project in Ontario. Stellantis postponing the Dodge Charger electric in Windsor. And Ford was planning to build electric vehicles in Oakville, Ontario, but that plan has been put on hold. So we've been hit by this cutback in EVs, haven't we?
Boy, what a list you just gave.
I'm sorry. Yeah.
Well, look, I mean, fundamentally, these companies are not charities and they're not state-owned enterprises like the Chinese. So they've got to make a profit to invest into new product, and they've got to make a product to be able to continue to produce vehicles and be going concerns. And so what Ford said yesterday fundamentally is, look, we put our money where our mouth was. We're writing down almost $20 billion. Doesn't mean it means that we didn't just protest from the sidelines. We gave it a shot. Part of the shot was premised on the fact that the U.S. Government, especially during the Biden administration, was so committed to it that it was going to subsidize production of electric vehicles and batteries, but also subsidize purchases and subsidize the infrastructure to charge and service these vehicles. Mm-hmm. When the Trump administration turned a full 180 on all three of those, they killed whatever short to midterm market potential there was for these vehicles. And unlike the Chinese-owned enterprises, Ford could only go to the market or they can go to the capital markets. And what they said was, we believe in electrification. We believe that that's part of extended range vehicles, hybrids that everybody likes, as a step into battery electric. There's no coincidence that the president last week, with the Ford CEO present, reduced the fuel economy targets for out years to say, okay, let's try it this way.
And of course, we've had disappointments on the battery front. Umicore, Belgian company, was going to build an Ontario EV battery materials plant for almost $3 billion. That's been put on hold. And now apparently Volkswagen, it's kind of a confusing story. They are seeking alternative sources of financing for their battery EV business because they're supposed to be building a giant factory in Ontario.
Yeah, look, Umicore, I think you're reporting properly on that. On PowerCo, we spoke with the company, government spoke with the company, in the last few days and weeks. They do have a business model that works. They've got a plant to build Scouts, a resurrected brand in South Carolina starting next year, as well as the current electric production in Tennessee and in Puebla, Mexico. And the plant in St. Thomas is the only one making batteries for those. But it is tough times, even for the ones that, even for the biggest companies in the world.
Right. So the Umicore plant is going ahead, is it?
No, I think Umicore is look, they're the only ones in that space. That space just got a lot smaller.
Oh, sure.
I'm sure it's a lot tougher going than when they cut the ribbon on that announcement a few years ago. But I'm saying that the PowerCo one is, things haven't changed for demand within the Volkswagen group for those batteries. And I'm pretty confident in St. Thomas, as I've always been.
Oh, I see. Yeah. Could the federal government have done more to encourage electric vehicle investment in Canada?
No, I think they did a pretty good job. They matched incredibly high production subsidies to get those investments in Canada rather than the U.S. And a lot of debate. I don't know how many times you had me on to try to defend the math, but they also structured the deal in different ways than we've seen in co-investments of the last 20 years, which is those billions were dependent on production. Make the batteries, show us the production evidence, and then we'll flow funds against that. And so I think the federal government, I think the industry here, everybody wants to see profitable electrification. But Canadians are not on tap for billions of dollars of subsidies until those things are made. And so when you see bad news, it's terrible news for workers and suppliers, but it isn't the same pain and punishment for taxpayers because those billions have not flown.
We've less than 30 seconds left. Just update us. You were involved in building a kind of pilot, a test rig for a Canadian electric vehicle. Did that ever go anywhere, or could we ever see an independent Canadian-made EV?
We'll go to the Canadian International Auto Show in February, and you'll see that Project Aero 2.0. It's not easy. If it was easy, my dog would do it, but we are still absolutely dedicated to it. You'll see the updated version there.
Thanks very much, Flavio. Great hearing from you. Flavio Volpe, president of the Automotive Parts Manufacturers Association. Coming up, we're going to stick with this story. Volkswagen is having troubles with its battery unit. We'll get more after the break. Some Maritimers are taking a step back from baking this holiday season in hopes of saving a bit of money. CTV's Emma Convey has more in this report.
Kelly Muse is missing a few sweet essentials in her grocery cart. High prices forcing her to cut back on her annual baking list.
Cookies or, some kind of bread, muffins, like all kinds of cooking, so usually something is on the go, pies, cake. But this year, nothing yet, because we're kind of like, money's tight.
For the baking she has done this season, she avoids making goods that need a lot of butter or eggs.
Normally you'd be baking up a storm constantly, but I know a lot of people are like, oh man, like, you know, things are so expensive, or constantly having to try to find the butter on sale.
And those cookies for Santa could cost bakers a bit more this year.
There's evidence out there that people are baking less just because of the price. It costs to actually buy ingredients.
Despite prices for some baking essentials dropping a bit in price, other key ingredients are up. Stats Canada found in 2024, butter was $5.93 a pound. This year, it's $5.79. Eggs were $5.23 for a dozen, and this year they're up to $5.43. White sugar has dropped from $2.71 per 2 kilograms to $2.56, while wheat flour is up from $4.47 in 2024 to about $5 in 2025.
For chocolate, generally speaking, we're seeing higher prices compared to last year. I'd say probably chocolate is anywhere between 15 to 20% more. Vanilla prices have actually gone up as well.
It's a lot of cookies, a lot of brownies, a lot of muffins in the morning. So we're going through probably 50 pounds of butter a week. And so again, we're just trying to shop around and find the best prices that we can.
This cafe downtown Halifax finds buying certain ingredients in bulk helps keep their costs down.
20 kilos of dark chocolate at a time. And I think right now that costs us about $500. And we're buying that every week or two.
Sylvain Lebois says some of these baking ingredients could also be shrinkflated. Less product, same price. He adds for those planning to bake this season, they may lean more towards shrinking their treat sizes as well. And this is obviously to help their recipes go a little bit farther.
Up next, we'll update you on the latest headlines and the markets, and we'll dig further into the troubles at Volkswagen's battery unit. Shares in Covio trading sharply higher today. The federal government has signed an agreement with the artificial intelligence platform to boost innovation and integration. Ottawa will work with Covio to adopt technologies that will help create cost-effective services for Canadians. One of the objects here is to ensure Canadian digital sovereignty. And shares in Hut 8 soaring. That company has signed a deal valued at $7 billion US to supply power to be used by the AI provider Anthropic in computing. US President Donald Trump has ordered a blockade of sanctioned oil tankers going into and leaving Venezuela. This move severely targets the country's economy, but will have a less profound impact on global markets due to the diminished status of Venezuela's oil industry. The OPEC members' crude output could potentially rebound if the governing regime were to change. The Maduro government, though, has characterized the U.S. actions as a grab for Venezuela's oil reserves, which are said to be the biggest in the world. And there is a look at the TSX. You can see our markets holding in, but we are seeing some selling in the U.S. market. Stocks edging down in the United States. Big traders right now. Tesla is actually up a bit. It hit a record high yesterday. Nvidia is down, though. Broadcom's down. Alphabet, Oracle, they are all losing altitude right now. Volkswagen's battery business is seeking external financing after the company cut its spending plan, and this has created a squeeze for the unit. Let's head to Frankfurt, Germany. We're joined by Marilyn Martin. Marilyn, thank you very much indeed for joining us. Just tell us what Volkswagen is saying, please.
Yeah, sure. So it's a pleasure to talk to you today.
So Volkswagen is doing yearly planning rounds where they announce how they will divide up the spending for the next 5 years between factories, models, and so on. The details are not clear yet. They will be announced in March 2026 approximately, but they already said that they will reduce investments to 160 billion euros. So that's approximately 260 billion Canadian dollars. That means that there's less money, of course, also for units like PowerCo. And PowerCo CEO Blume yesterday said that this is actually also because they have less of a demand for their products, so they also need less investments right now. But of course, that also means that they need to look for other investments in the midterm. They are considering an IPO, they consider external financing, bank credits. They talk to different investors, apparently. They don't want to go into details yet, who that is. But yeah, they're currently trying to figure out how to secure their financing in the midterm now that the investments will be lower than initially thought.
And then one of the options here might be an actual stock issue by this battery unit?
Exactly. So they set up the company in a way that they could, IPO, but currently it's not clear, and they said it's also up for Volkswagen to decide that because it's a unit from Volkswagen, as said before, so it's not really their own decision only. But yeah, they are considering all options right now. They're talking with investors. They started doing that after founding the unit already in 2022, so it's an ongoing process, but this is now, like, the pressure is higher now, the CEO said yesterday. So basically they need to figure out how to get external financing outside of Volkswagen, just because the automaker is struggling and has less investments for its battery unit.
As I'm sure you know, Volkswagen is working on a gigantic battery factory here in Ontario, in Canada. Have they cut back on actual battery production plans anywhere, though?
Yeah, exactly. So today was actually the commissioning of their battery factory in Salzgitter in Germany. And they're still planning to ramp up production, or construct the plants first and then ramp up production in Spain and in Canada. They originally planned for 6 battery plants overall, but now they cut it down to those 3 plants mainly, and their first line production in China, which is already going, but that's nothing where they will produce a lot of volume. That was only for kind of testing purposes. Now the Salzgitter factory was commissioned today, and they are now using the cells, or supplying the batteries for the first models already, but they are not going into serial production. They have last road tests and everything. And then serial production will start in the next 6 to 12 months in Germany. And then for the Spanish plant, they plan to have serial production in 2027. And for St. Thomas in Canada, it will probably start in 2028. That's the current timeline.
It's amazing how the auto industry globally is cooling its jets on electric vehicles, except in China, it seems. Thank you very much, Marilyn. Really appreciate it. That's
Thank you.
Bloomberg reporter Marilyn Martin joining us from Frankfurt. I remember passing through Frankfurt Airport when I was 17, and wow, it was a different world from what I was used to. Coming up, hot picks. We're going to check out 3 plays in the cannabis sector, including one stock that has jumped more than 175% so far this year. The cannabis sector has been a laggard this year. The Global Marijuana Life Sciences Index, which aims to replicate the performance of North American cannabis stocks, is up only about 5% this calendar year. However, our guest top pick has outperformed the index with gains of more than 175%. Let's get more from Kenrick Tai, a special situations analyst at Canaccord. Kenrick, thanks very much indeed for joining us. Start off with Curaleaf, if you would, please.
Absolutely. So Curaleaf has long been one of the darlings in the cannabis space. Very strong domestic footprint combined with a very large international business. That business is heavily represented in Germany and various other international markets. In terms of their domestic footprint, they really are in the key markets in the US, including a high concentration in the Northeast. They have recently signed an agreement to purchase assets in Virginia. As a reminder, Virginia is one of the key catalyst states through the next number of years, with an expected start to adult use in early 2026, which essentially in that first year, Virginia is expected to generate north of $500 million in legal sales, with path to being a $1.8 billion market over the next number of years. So that certainly is one of those names that has been at the forefront of any discussion around the cannabis space, and certainly a name that we've been positive on for a period of time here.
And sorry, what are their big markets again? Henry, just remind us.
So, I mean, domestically, they have a presence across, the majority of major legal states in the US. And then in Europe, they have a presence in Germany, the UK, as two of their largest international markets.
TerraSend is your next idea. They're also active in the States. Tell us what attracts you to this stock.
Sure. So TerraSend is a very concentrated play. The beauty about TerraSend is that they're not in every market in the US, but they are in some of the highest growth markets. Think markets the likes of New Jersey, Maryland, Pennsylvania, Ohio, some combination of either recently legalized adult use markets or markets that are expected to legalize adult use in the short term, specifically a market the likes of Pennsylvania, which I should also highlight Curaleaf, Verano, and TerraSend all present in that market. And that is one of the key states as well to watch over the next couple of years. In fact, in terms of key states, the big catalyst states through any reasonable forecast window here would be Florida on potential adult use, Pennsylvania on potential adult use, and Virginia on the start of adult use sales in early 2026.
And then talk to us about Verano Holdings. They have had a litigation overhang on the stock.
And that litigation overhang has thankfully been resolved. It related to we'll call it a failed acquisition going back a number of years. That was recently settled, which is a big positive in terms of the name. I think on Verano, one of the misunderstood pieces here is just how well represented they are in some very high growth states. They are the number 2 in Florida behind the market leader Trulieve, and yet they trade at a big discount versus the group. This is one of those names that has often been overlooked, and certainly one that I think would warrant further attention.
And sorry, their latest results were a miss, but behind the scenes, you think the company is addressing problems?
Absolutely. If you look at what drove that miss, there was nothing in it that would have caused or would cause me concern or any sort of negative revisions to my outlook, much less to my thesis on the name. These are quality operators with quality assets in some very attractive markets.
And so generally, do you favor retailers or producers, or do you like a bit of both in a company?
Great question. It really depends on how established or how mature that market is. If you look at a market the likes of Maryland, where you have a lot of retail doors opening very quickly, you're going to favor a cultivation forward producer who's actually supplying into those doors versus competing with all of those new opening doors. It's a lot easier to be making money supplying into an explosion of retail than competing with an explosion at retail. So it really does depend, as I said, on maturity of the market, the dynamics within that market. Maryland today is a market where being producer forward would favor you, and that would favor the likes of a TerraSend. There are certain other markets where a fairly balanced portfolio would make some sense.
As you know, before decriminalization and legalization, we heard predictions, well, this industry will go the way of other consumer products industries. Maybe we'll get the big pharma buying it up or the big food companies. Haven't really seen that. I know we have seen major investments by the likes of Altria.
Yeah, and I think that those types of investments, or having big pharma or big ag coming in, that's really only going to be in a sort of federally legal world. I think between here and there, on the back of rescheduling, we see some increased flexibility. I think you can also expect to see some increased focus from institutional investors in the space, big banks focusing increasingly on the space and the provision of a full suite of banking services. But that next level, or that next step, by way of big pharma or big ag moving into the space, I think that's a number of years out and would be built off the back of federal legalization, should that happen.
And broadly speaking, is banking still a hassle for companies in this industry?
Banking is still a very, very big problem for companies in this industry. Essentially, you have an industry today that is north of $40 billion at retail, 40 billion US at retail, that is an entirely cash-based, cash-dependent business.
Wow.
So they cannot accept credit cards. That's potentially changes on rescheduling should that go through. But just think about the complexity there. Smaller average ticket on cash versus credit. And then, of course, all the cash management and cash-related security concerns. Being a $40+ billion retail business and only being able to accept cash is problematic.
It's interesting. In Canada, the stores, I mean, they're legal stores, obviously, at the federal level, they can take debit cards. I'm not sure if they can take credit cards. I assume they can.
Yeah, no, the Canadian market as a fully legalized recreational market, very different sort of state of play and rules of engagement. Certainly the US has significantly higher levels of sort of significantly higher constraints and barriers in the operating for the key players.
And I guess you can't blame the banks for being cautious. Yeah, the stuff is still illegal at the federal level. Kenrick, thank you very much for joining us.
No, cheers. Thank you, Andrew.
Kenrick Chag, a special situations analyst at Canaccord Genuity. Let's check out some notable analyst calls and recommendations this morning. The first is on Warby Parker, the eyewear company. Telsey Advisory is raising the price target on Warby Parker to $32 US from $24, sticking with a buy rating. Telsey providing its outlook on top picks for 2026, and the firm is naming Warby Parker as one of its top ideas in consumer technology, saying the company is well positioned for more growth. Our second notable call is on Lowe's, the home improvement chain. Truist is raising its price target on Lowe's to $269 US from $256 and sticking with a buy rating. This is part of a research note previewing 2026 for hardlines, broadlines, consumer names. Of course, the firm anticipates and has been seeing some slower consumer trends, especially in the second half of fiscal 2025. And it says shoppers will remain cautious with a continued focus on value. And finally, Best Buy. Best Buy's price target has been cut to $77 US from $84 at Truist. Truist sticking with a hold rating on the shares. You can see they are down over the past year. Again, this is part of its preview for consumer names in 2026. Truist says to put a buy on this company, you'd need a stronger product cycle to generate more sustainable growth. And products such as AI hardware, smart glasses, and gaming provide opportunities. It's still questionable whether the company can maintain momentum on same-store sales growth. Coming up, more on the blockade facing oil tankers going into and leaving Venezuela. U.S. President Donald Trump says he's ordering a blockade of sanctioned oil tankers going into and leaving Venezuela. This ratchets up pressure on the regime in Caracas amid a U.S. military buildup in the region and the threat of land strikes. Bloomberg has more in this report.
He's been putting pressure on this regime, and one way to tighten that pressure even more would obviously be taking one of their biggest revenue areas, and that's oil. Putting curbs on their oil exports. Already, he's been tightening that through the seizure of a ship earlier this month, as well as just restrictions in general, have helped to curb the amount of money flowing into Venezuela and in particular U.S. dollars. But by doing this, you're really siphoning off a very large portion of the revenues from that the regime can get. Now, there are a few reasons for this. One, Trump has for a long time blamed Venezuela for a flood of drugs coming to the country. You've seen the U.S. administration hit several, over a dozen ships that were suspected of carrying drugs and being involved with the cartels. He's also blamed Venezuela for a surge in illegal immigrants coming into the country, which is something that he struck quite hard during the campaign trail. So, of course, this is sort of a ratcheting up of this pressure, and it's in the onset that we're in a bit of a market glut. The U.S. is producing a lot of oil. Prices are pretty weak. So with all that together, Trump and the administration thought that this was their time to strike.
Yeah, and we can see that, can't we, when we check the oil market. So, yes, we're seeing a move of almost 1.5% up on oil prices, but Brent is still below $60 a barrel. So, Stephen, what does it mean? How central does Venezuela play? What kind of the centrality of that nation in terms of its oil exports onto the market, and how this could affect pricing going forward?
You know, I think this is more sentiment-driven, any increase that we see today, than really actual changes in the fundamentals for the oil market. Because, listen, Venezuela last month was producing or exporting roughly 500 to 600,000 barrels a day. Now, to put that into perspective, the global oil market consumes about 100 million barrels a day, so that's less than 1%. So if you remove even all of that, and that's not what Trump is suggesting. He's suggesting just the shadow fleet ships, these dark sanctioned ships, which make up a portion, but not all, of the export from Venezuela, you're not going to be really changing the fundamentals very much, but it does show some sort of discombobulation in the market. There is obviously there's going to be some degree of scramble. A lot of that oil was going to China. Where do they find the replacements? Are there the grades that they can find elsewhere to feed their industries? That's going to be something in focus. But when you do zoom out, a 1% gain is nothing compared to where we're sitting in the oil market. We had prices fall just recently this week to the lowest level since 2021. Oil prices are weak. There is a glut that is expected to get worse in 2026. So even if you were removing these Venezuelan barrels from the market for a prolonged period of time, you're not going to be seeing a sustained increase. In fact, there's probably more downside for the oil market.
Shares in Lundin Gold have soared this year. It's among the best performing gold stocks. The company is recognized as one of the lowest cost gold producers annually. Its giant mine in Ecuador, Fruta del Norte, produces about 500,000 ounces of gold each year. We were joined by Jamie Beck, CEO of Lundin Gold.
With some of the analyst reports is really how excited we are with the exploration potential here. This has been a incredibly active geologic environment, and we have been discovering significant potential new deposits, not only on the gold side but also in some copper and gold. So it's hard when you're staring at sort of the quarterly production figures to really bake that exploration upside into the share price, but we think it's firmly there.
You just came out with your 3-year outlook, and one big decision that's expected is this Fruta del Norte South. Give us some numbers there. If you develop that, how much would it add to your production?
Yeah, we're sort of putting the initial resource and reserve estimates together at the moment. So I don't have exact numbers, but we have an initial view that this could add upwards of 2+ million ounces, I think, into the overall life of mine plan. I don't see that that's necessarily going to mean that we would exceed that sort of 500,000 ounce a year production figure, but the hope would be that we'd be able to extend the mine life by bringing that FDN South material into the mix.
Now, your cost base is pretty low. I mean, it's below $1,000 US an ounce. I mean, it's got to be among the lowest of major gold miners. Pretty nice when we've got gold at $4,000 plus. You're making plenty of money right now.
Yeah, it sure is. This is a very, very special asset, and the grades that we're mining underground help guide that low cost production. Has really provided some operational excellence in terms of not only our production but also cost, as you suggest. So yeah, certainly at these gold prices, we're making good margins.
Scotia says that the costs were a little bit higher than they had forecast, but they do say expansion could bring down that cost. It's interesting, though, that part of this is employee profit sharing that's adding to the cost base.
Yeah, that's right. For every $100 of gold price increase, we add about $10 into our overall cost based on the royalties and the the employee profit sharing as you described. So, our previous guidance in 2024, when we put out guidance for this past year, we budgeted that at $2,500 an ounce gold. So as we're sitting here north of $4,000 an ounce. That royalty and profit sharing adds upwards of $150 to our cost basis, but certainly I'll take that increase in cost at the higher gold price.
Right, and you're spending something like, is it in the next year you plan to spend more than $80 million on exploration, your biggest ever?
We've got our biggest program ever. You're right. About 120,000 meters drilled in 2025, and we're planning about 130 some odd thousand meters in 2026. There's an $85 million program going, and really focused on three key areas. Andrew, number one is replacing reserves. So we've been incredibly successful at Fruta del Norte at replacing the gold that we've mined every single year. Number two is sort of in some near mine exploration where we've had great success, both gold as well as copper gold. There's a number of new copper gold porphyry targets that look incredibly exciting. And then there's just a huge land package. This project was picked up, by the Lundins in the mid 2010s. And a lot of the effort has been on really building FDN and getting it up and into production. And now we're casting the web further afield and going to do a bit more regional exploration. So it's really exciting.
It is interesting. Ecuador doesn't have as developed a mining industry as somewhere like Peru or Chile, and it was seen as a tricky place to do business. I mean, there were protests back in 2020, I remember.
Yes, it's for all of its geologic potential, there's been challenges, of course, in terms of getting projects off the ground. We've had, just a wonderful experience in Ecuador, working with the government, working with the local communities. All the stakeholders have been incredibly supportive of what we're doing at Fruta del Norte. So, I really hope that there's a number of projects that are sort of in the pipeline. I think that would be incredibly beneficial for Ecuador, for their people, for the government, for the country in its whole. And so we're certainly cheering on the sidelines that we can get more projects going. But for now, this Lundin Gold and Fruta del Norte is a pretty important player in the Ecuadorian mining space.
Yeah, are you the biggest mine in Ecuador?
Well, we're probably the largest taxpayer. There is a Chinese operated operation, the Exa mine. That's the Mirador. It's a copper gold deposit that's just to our north. It's a big open pit, so it's likely a larger mine from a production perspective. But between those two, those are probably the two biggest in country.
Know Your Options is back. Tune in today at 3 p.m. Eastern to get all of your options trading questions answered by Chris Tom of Moat Financial. Get your questions in right now. Know Your Options at bnnbloomberg.ca. That wraps up this edition of The Open. Thanks so much for watching. Morning Markets is up next.